So looking forward to today. This is a topic that I am very passionate about, and that is just stewardship in general. And for a lot of people, that could mean something different. But we're going to talk a little bit about stewardship. And just to give you some background information about myself, I am the Director of Financial Planning here at the Financial Enhancement Group. We are an Indiana-based company, but we do have offices outside of Indiana, and we have some families that we take care of in over 31 states. And just to give you a little bit of background information about me, I started in this industry really in December of 2005. I've always had a passion towards the financial industry because it's a way that I can serve people. And that's one of my qualities is just leading with a servant's driven heart. And so I have the high school yearbook picture. I graduated in 1999, so starting to age myself. But in my high school yearbook, I knew that I wanted to be a financial planner. And so that's come to fruition. Went to college for 4 years, worked construction going through college. Doing that growing up in Michigan, quickly realized that I didn't want to be outside in Michigan winters building houses, putting siding and roofing on things. And so I went into the financial services industry after I got out of college and started with a company called John Hancock. And so over the course of the last decade, I've been with Financial Enhancement Group, and I am a partner here. And so what we're going to talk about today, I also have the Certified Kingdom Advisor designation, which is very much an emphasis on helping people steward their resources well in accordance to Christian values. But stewardship also does not mean that you have to be a Christian to steward resources. And we'll talk a little bit about that today. So again, welcome. I hope you get a lot out of what we talk about today. Legally, I have to put a disclaimer out there. Financial Enhancement Group is an SEC registered investment advisor. To those of you watching and joining, all that means is we manage more than 100 million in assets, and we are a fiduciary, meaning we legally have to do what's in the best interest of the families that we take care of. So we are SEC registered. The disclaimer's there. Our company has been independently serving families for over 28 years, and we have 4 offices here in central Indiana. And part of the way that we serve is giving back our time. And so that's what we're doing with this series. And so over the course of 8 months, 7 to 8 months this year, we're going to go through a workshop series. And as you can see on the screen, coming up May 22nd, we're going to talk about strategic generosity, being a better giver. In July, we're going to talk about legacy planning. In August, we're going to talk about investing. September, tax smart strategy. October, we're getting back into tax season and making sure we're getting things done prior to the end of the year for any sort of tax planning. And so we'll focus the last 2 sessions on making sure that they're tax centric. So those are coming up. You can see those on the screen. I'll reference those at the end. One other thing, as I'm talking through these, if you have questions, please put them in the chat. I will answer questions at the end. And last disclaimer, as I'm going through the topics today, I'm going to talk a lot in just generalities. I'm not going to be very specific to situations. If you have questions, at the end, we'll invite you in for a meeting to answer those individual specific questions. So what we're going to cover today, we're going to talk about stewardship, financial spring cleaning, budgeting with a purpose, 3 phases of finance, integrating some faith-based values, and talk about next steps. So let's go ahead and get into it. Why is purposeful stewardship, why does it matter? And what is stewardship? Stewardship is an intentional management of resources. It's being wise with what you've been blessed with. It's making sure that you're taking care of the resources that you were given. It's aligning money with your faith, with your values, with your priorities. And lastly, it can be impacting to family and your community through purposeful decisions. And so, using the resources that you have the ability to make a good impact on a lot of things that are close and passionate to your heart. Here at FEG, here at the Financial Enhancement Group, we help a lot of our families through different charitable causes. We help them through using tools like a QCD. We help them through using giving through out of their required minimum distributions. And so being a steward of those is making sure that you have purpose and intention with what you're trying to accomplish. What I really want to talk about right now is things that we can do from a financial spring cleaning. So most all of you know that taxes are due on April 15th. And on April 15th, we had to make sure if we owed the IRS money, we had to have that check paid in. Or if you got a refund, that had to be filed by April 15th. And so what we're going to talk through are some things that you can do after tax season to clean up your financial lifestyle. And so what are some of those things that you can do to clean up or just financial spring cleaning in general? Tax season really gives us a clear picture of where your money went. Think of things like if you itemize, you can deduct your mortgage interest. And so if you have mortgage interest, you know how much you paid to have the property of your house. You can look at ways to reduce taxes. So did you give inside of your 401k or an IRA to reduce your taxes? Really, that tax return shows where dollars went. And so after tax season, it's really a good idea to look at where your year was and review. And so some of the things from a spring cleaning standpoint is reviewing things with a fresh set of eyes. Make sure I get that on the right screen here. Go back one slide. Identifying financial clutter. Things to think about like that would be looking at outdated plans. So making sure that your financial plan is in order. Overlooked expenses. One of the items there that happens a lot of times is there's subscription services that you can have that are sometimes overlooked. I was just reviewing a credit card statement for my wife and I and realized that we still pay $7.99 a month for a Peacock subscription. That is the NBC version, I think NBC version of their streaming service. And for whatever reason, I purchased that a couple months back to watch some sporting event and forgot to cancel the subscription. And so those are things that I like to say they eat while you sleep. Your Netflix subscriptions, your Apple data plans, most everything has some form of subscription service today, and we can get into paying for things that we're not necessarily using anymore. And so I just found one for my wife and I. It was $8 a month. Equates to $100 a year. If I don't cancel that, I'm just frivolously spending $100 a year. And so there's a lot of times when you can get rid of subscription services that you may or may not be using. A couple other things is making sure that you're aligning your financial strategy with your values. And we'll talk about budgeting today. I'm not going to get into a lot of detail about, where dollars are being spent, but you want to make sure that you are looking at aligning your financial strategy with your values. And that could be making sure that you're gifting to a charity that you're passionate about, or spending dollars at stores that, maybe a small business that you're passionate about. And so just making a kind of a fresh reset on what you did last year is a good idea to make sure that what you're doing in 2025 gets cleaned up. Another area that often goes overlooked is making sure that people have access um, to your online resources. So a lot of times there will be a subscription or there will be some sort of service that you use. Let me just take a step back. I like to watch a lot of movies. And so Amazon Prime is filled with old movies that I like, whether it's an old Western or it's, something that I grew up watching with my dad or grandfather. You have an online content of data. And so outside of just your spouse or someone, that is a resource that you should have someone have access to, and at least put that in your plan to make sure there's a plan for that. So financial spring cleaning, just to refresh, is taking a look at the last year in review, and seeing if you can do anything different this year and trying to eliminate clutter. And clutter can come in many forms. A lot of, things that you can do is shred old documents. Those are things that we get asked here at FEG all the time. How long should I keep my investment statement, or how long should I keep a tax return? Um, our investment statements, we can get up to 7 to 8 years worth of those here at Charles Schwab. So you really don't need to keep hard copies of those because we keep an electronic storage for a lot of our families. Tax returns are always good to keep for 5 to 7 years. And you don't really need to have a hard copy. You can scan those and upload them into a file. But you don't need to have all of those documents. I've had people come in into the office with 40 years worth of tracking different savings bonds and types of things. Those were once good, but you don't need to have 40 years worth of data tracked anymore because you can put it in a different area. And so anything that can reduce stress, reduce clutter, you want to do that with your financial resources as well. Budgeting with a purpose. Gosh, that is it's a nasty word. I hate the word budget. I'm just being fully transparent. But if you don't budget, you cannot track and be a good steward of where your dollars are going. And so budgeting is very critical to making sure you're being a good steward of the resources that you're blessed to have. We can talk about a couple of things and why budgeting is important. It's really a reflection of your values and priorities. A budget can tell where your dollars are going. Uh, if you haven't noticed yet, I'm very transparent. I love to golf. So I can tell you where dollars are going during April through October here in Indiana. They're usually spent at the golf course. In the wintertime, here in Indiana, it stinks and we're pretty much holed up for about 5 to 6 months. And so I redirect some of those dollars so that I can use those on the golf course April through October. And so budgets are a good reflection of your values and priorities. One of the things we get asked often when we have folks come into the office is, do you need to see an itemized budget, like where every dollar goes? No, as a financial advisor, I don't care if you spend $5 to buy yourself a cup of coffee at Starbucks or your favorite drink, but I do need to know that you're not outspending the income that's coming in on a monthly basis. And so budgeting and tracking those dollars are vitally important. It also allows you, as I said, to steward those resources well. If you don't have a budget, you can develop bad financial habits. And habits are forming over time. So you can start to develop bad financial habits, that Starbucks coffee that you get every week turns into maybe a couple times a week, turns into a daily habit, and those daily habits have an expense to it that can add up over time. I'm not saying that's a good thing or a bad thing, but if you're not tracking those dollars and you're not stewarding those dollars well, it can be a reflection of having to redirect those in a different area. And one thing that it can lead to is it could impact your giving. So if you're spending money in different areas that are not aligned with your values, it can impact the ability to make an impact. It can impact the ability to donate to a charity of your choice. And so that's a part of stewardship as well, is making sure that you're tracking where dollars go. I am a nerd when it comes to budgeting. I use a couple of different things. One resource we use is a financial planning tool. So here in the office, I've got a financial plan built out, but when it gets into more of the specifics, you can use a lot of things to budget. If you have access to Excel, a simple Excel spreadsheet in a template, you can type in budget, and there's already budgeted templates that you can get out of Excel. There's several apps that you can go if you have an Apple or an Android. A couple of the big budgeting apps, you can just type in budget, and Dave Ramsey has a very good budgeting tool. It's called Every Dollar. There's several budgeting apps out there that allows you to track where your dollars are going. And it really can allow you so it can track where they're going, but the budgeting apps also allow a snapshot into your life. And so what I mean by that is you can have them access your bank accounts to where it will start tracking those types of things for you. Now, in an Excel spreadsheet, you're probably going to have to plug those numbers in yourself, but a lot of those budgeting apps actually integrate with your bank accounts, your credit card accounts, and you can track those well. Personally, I use Quicken. It's an old, outdated system, but I like the ability to be able to track a lot of that stuff. I do have it linked up to my bank accounts, credit card accounts, so that I can go in and categorize where I'm spending dollars. I know how much I spend for home ownership, know how much we spend on gas. And so if you're going to go the Dave Ramsey principle route, you want to make sure every dollar is accounted for. And when you budget, here is a big thing. You have to realize what is your gross income and what is your net income. Gross is what you make pre-tax, and net is what you make after tax. Most of the time, unless you can tell me differently, what hits your bank account is after tax, after your 401k deductions, after your health savings account deductions, after your health insurance benefits come out of your account. That net amount is usually what goes into your bank account, and that's what you use from an operating standpoint. So when you're setting up a budget, make sure you know what that net income is on a monthly basis to be able to accommodate $4. Budgeting affects all areas of life. And I'm going to walk through what we call the 3 phases of finance. But budgeting is vitally important if you are moving into the last phase of finance, which is distribution. And we're going to talk about standard of living as well. It is vitally important to make sure you understand where your dollars are going when you're getting ready to retire, because you have to build income streams around those dollars. And so you have to understand where dollars are going. So and I briefly hit on this, is another reason to budget is it allows you to prioritize generosity. It allows you to save diligently, and it allows you to spend intentionally. And so generosity, saving and spending intentionally. The old adage is, you give 10 to 20%, generally 10% for a tithe. Saving, you want to do another 10 to 20% and then live off the 60 or 70% that's left over. I know if you're young and watching this, it is very hard with inflation. It's very hard with what's going on economically in the United States. Home values are up, interest rates are up, but you have to have a plan in place to make sure that your financial well-being is taken care of. As I said, we're going to talk a little bit about the three phases of finance. The reason that's important is because everybody walks through these in their financial life cycle. And so I want to talk about those not in depth, but just in broad base today. If you have questions, I will, like I said, answer those at the end. So the three phases of finance, we were taught, as professionals that we all go through really three different types of things. And if my computer will catch up here, we'll get to what that first phase of finance is. It's accumulation, preservation, and distribution. And that is not age-based. I just want to put that out there right now. Going through accumulation, preservation, and distribution is not specifically age-based. It can be. If you start off at a younger age, most people start accumulating at a younger age, but it doesn't mean that you can't start accumulating in your 30s versus 20s. It is a process that everybody goes through. It does not depend on age. Obviously, the earlier you start to accumulate, the better you have compounding interest working for you over time. So accumulation, preservation, and distribution, we're going to talk about the importance of all three of those today. In the accumulation phase, and again, why budgeting really matters is you want to make sure that you're saving the right percentage of your income. Now, the younger you are, the smaller that percent is that you have to save. So if you're, 20 years old, you have time working on your side, long-term time that will allow compounding interest to, really start to work in your later years. So as if you're in your 20s and you're starting to save, you don't necessarily need to save a specific amount. When we talk about the phases of finance and going down a financial journey, if I'm coaching someone here as a family that we take care of, we want to have them start with the end in mind. And what I mean by that is, what do you want retirement to look like? What do you want your life after work to look like? What do you want to do from a charitable standpoint? Are there college things that you want to take care of for your kids? And so for everybody, those are different answers. The things that I'm trying to accomplish could be different than Tarna or Jubilee or Lisa or John, who's on here, or a number of you folks that are on the screen. And so a lot of these phases affect people in different ways. And so the best thing to do in accumulation is make sure that you're saving the right percent of your income. And again, that's different for everybody. And making sure you're building tax diversification. I'm going to say that one more time. Saving the right percentage of your income and making sure you're building tax diversification. If you work on those two things in accumulation later on, your life after work, your distribution phase of finance will go really well. If you do not build tax diversification, you are leaving yourself in a bad future spot. And for doing this for quite a few years, we've had to help people unwind tax decisions. And it's not tax decisions that you've made negligently. For most people, they didn't have the ability to build tax deferred or making different tax type investments. The Roth IRA did not start until 1997. So a lot of people didn't have the opportunity to accumulate dollars in a Roth IRA. Even when the Roth started back in 1997, you could only put $2,000 into it, and your income had to be less than $100,000 a year. So for a lot of people, you didn't have the ability to build that tax diversification. So the three types of buckets that you can build tax diversification in today are tax deferred accounts. They're Roth IRAs, which are tax free, and then they're brokerage accounts or savings accounts. The difference on how those work is a tax deferred account like a 401k that is non-Roth or an IRA is you're deferring taxes until a later date. So you add money into that account, it grows for a number of years. The IRS says at 59 and a half, you are now eligible to do a withdrawal without a 10% penalty, but what you will pay is ordinary income tax on those distributions. Your Roth IRA contributions, those are after tax. So you're paying the tax today for future tax-free growth and tax-free distributions. And the last bucket is that brokerage account or savings account. Those you get a 1099 statement on the year in the year that a transaction was taken place. So if you had a capital gain, if you had dividends, interest, those are reported in that tax year. The reason why you want to build tax diversification because it allows you to control taxation when you move into the distribution phase of life. The old adage is that I've seen is we're going to accumulate money and then we're going to distribute it because in our later years, we're not going to make as much money. That is complete false. A lot of the families that we take care of here at FEG earn just about as much income as if they were working because they have pensions, they have Social Security, they have real estate. There are other income streams that will affect that tax return. So if every dollar that you save over the course of your saving life and it's all tax deferred, you are subject to the IRS's tax. Currently today, our tax brackets are reduced. Our marginal rates are compressed because of the Tax Cuts and Jobs Act that took place in 2017. Those are set to go away this year if Congress doesn't vote to change it. So our taxes will go up at the end of 2025 unless we have a vote to modify or redesign current tax code. So our 12% tax bracket is going to go up to 15. The 22% tax bracket is going to go up to 25. 24% bracket is going to go up to 28, all the way up to 39.6% at the top of the tax code. So that is why it's vitally important to build tax diversification, is because tax rates change over time. One thing we point out a lot is, people talk about the 39.6% tax bracket being super high. Well, when Kennedy was in office, that top tax rate was 90%. When Reagan took office, it was 70, and he overhauled the tax code back in the early 80s. And so, yes, 39.6 is a lot, but it was 90 back 60 some years ago, 80 years ago. So we're going to move on. Once you get out of the accumulation phase, there's going to be a point in time where the assets that you've built up are now more pressing to you than accumulating, than saving that percentage of money. And so what should be focused on in the preservation is making sure that your financial well-being, your family's financial well-being is being taken care of, and making sure lifestyle creep doesn't kick you in the butt. And what I mean about lifestyle creep is as you move through preservation, generally you're in your highest earning years. That's when you're, years into a career and you're making the best amount of money that you can inside of your career. A lot of times lifestyle creep kicks in. And what that is it's you're increasing your spending along with your income. And I'm not saying that's a bad thing if it's controlled and managed, But there's times where we see people here in the office to where their lifestyle creep has creeped up dollar for dollar with their income. And when you get ready to retire and move into that distribution phase, we've got to have a very frank meeting saying, hey, we've got to reduce some of this, or else you're not going to be able to, uh, you're going to outlive your money. And so you can still make sure you're being a good steward of your income. Just make sure that lifestyle creep doesn't get in the way. And we see that a lot of times where people will go and, buy a newer car or buy a bigger house or, have a vacation home. All of those things are fine if you have the margin to be able to do that. It's just you don't want to carry those things into distribution because it's an expense that adds to that standard of living, which I'll talk about here in a couple minutes. So preservation um, is making sure that you don't get into that lifestyle creep. So that income that's coming in, those higher wages, making sure you're budgeting, directing those dollars in good places, and also making sure that financially you have a good, sound financial plan put in place, evaluating things like life insurance, disability insurances, making sure if those what ifs of life you're insured for to make sure that your family's taken care of if you were no longer here. Last phase, and this is where FEG, our company, helps a lot of folks out, is that distribution phase. We take care of over 1,200 families in 30 states, and everybody's journey is unique and different. But one thing that I do know, one thing that has been very prevalent is distribution happens whether you want it to or not. And what I mean by that is that three-letter acronym that I said that can control your taxes, the IRS, they can also control your distributions because they're going to force you to take money out of your tax deferred accounts when you turn age 73 currently, and then in the year 2033, it goes up to age 75. So you're either going to have a designed distribution, which means you're in control, or you're going to have a forced distribution because the IRS is going to dictate what you're going to do with your dollars. So the important part about distribution is making sure you understand your standard of living. And I'm going to talk about that for just a minute. As I mentioned earlier in the budgeting part, understanding that standard of living is vitally important to the distribution side. If we do not get an accurate number when you move into distribution, as planners, it does not, we could make mistakes. So if you tell me you spend, $3,000 a month and you actually spend $6,000 a month, and I'm building a financial plan around you spending $3,000 a month, your dollars are going to last a whole heap longer than if you were spending $6,000 a month. So making sure that you understand that standard of living in your last phase, in that distribution phase, is very important. The way that you want to look at that is breaking it down into two different types. So you want to know what your fixed expenses are and what your social expenses are. Social expenses are the fun things. It's the travel, it's going to see the grandkids, it's helping do things that you're passionate about. As planners, we want to know how much you're going to spend on that social side. And generally what we do is we flatline that because as you age, those costs tend to decrease. You don't travel as much. The couch gets too comfy. If you're married, sometimes, a spouse can't get away from a doctor. Sorry for saying that. I'm just being transparent. Those are things that we see. You have a health issue that comes up. Those things, so we will flatline that. It could be $10,000 a year. It could be 20, whatever it is that you're trying to do in that distribution phase. We want to know what that social part is because that's an expense that generally trends down. The fixed things are the things that you can't get away from. Utility bills, cable costs, internet bills, homeowners insurance, property taxes, service type things. With the fixed expenses, you really need to build an inflationary cost to that, because as you continue to age, and what you're experiencing now is inflation. Things get more expensive. And so, from a fixed standpoint, if we were building a financial plan, we want to inflate those expenses over time. And so you need to create a tax efficient distribution strategy that helps to meet your standard of living. And so let's put an example out there. Here in the state of Indiana, you can modestly live on $5,000 to $6,000 a month if you're not raising a household, if you don't have kids, if you're not trying to put them through college, if you're married couple. You can, most of the numbers that I hear, it takes us somewhere between $5,000 and $6,000 a month to live. Now, for those of you that are watching in different parts of the country, like Florida, the New Yorks, the Californias, yes, we understand that you have a higher standard of living. And so in Indiana, let's say you need $5,000 a month to meet that standard of living. The first thing we're going to ask you is that gross or net? Do you need that before or after taxes? That's important. So once we know, hey, we need a net $5,000 a month, that's when you want to build a tax efficient strategy around where those dollars are coming from. If you're under age 73 and you have IRA dollars, it may make sense to take distributions out of your IRA to limit future required minimum distributions, let your Roth buckets grow. Sometimes we have folks delay Social Security because Social Security gets an increase every year that you wait past 62. All of these things have to be accounted for in making sure that you're building a tax efficient distribution strategy. And then the other big thing in distribution is managing volatility through those distribution points. We are in April of this year of 2025. Last time I checked, it's the 17th today. Easter weekend's coming up. But volatility has hit the shores here in our financial markets the last couple months. And so we want to make sure that if you're taking money out of your accounts, the accounts that you're taking money from are being managed wisely to where they're not as subject to those ups and downs of the market. And so a dollar taken out today for standard of living is a dollar that does not get a chance to grow in the future. So let me say that one more time. A dollar that you take out for your standard of living is a dollar that does not have the ability to grow in the future. And so if we're taking a dollar out in a compressed market, that dollar never has a chance to grow back up with market growth. So that's why you have to manage the volatility through those distribution points. Very important to make sure we do that. I'm going to quickly go through these because I want to get to a point to where if there are questions, I can answer those. A lot of what I'm talking about is making sure that the principles and values that you have are aligned with your goals. As I said in the opening, I'm a Christian, and so a lot of the values that I have flow through the Christian principles, and stewardship is one of those. It's making sure that I'm using the resources that God's blessed my family with in a wise manner. You want to make sure that you're honoring your faith and family with your financial decisions and making sure those dollars are going in the direction that align with those visions and values and beliefs. And then encouraging community and making a generational impact through responsible stewardship. And as I said earlier here at FEG, We are very big believers in making sure that if you are in any way, shape, or form charitably inclined, we want to make sure that we help you do that in the most tax efficient way. So some next steps to think about. You want to assess your current stewardship practices. You know, align those with your family, align those with the family vision, align those with whatever's important to you, and then you can direct the dollars to where it aligns with your vision and values. You can identify immediate opportunities for purposeful alignment. There's so many causes right now that are charities and things that are in need. Um, as we get into, market times that are a little depressed, people get a little bit more apprehensive on giving. And so a lot of the charities and things that you have given to in the past are affected as well. And so there's, a lot of different places that could use an immediate impact. I'm not going to go into who those are. You know who they are from your own vision and values. And lastly, it's you need to schedule regular financial check-ins in making sure that it's anchored by your faith and by your values. So those dollars that are being accounted for through budgeting, are they going to the places that you wanted them to go to? Are you making a purposeful impact with your charitable gifting? Are you saving in a wise manner so that you can lead yourself through those accumulation, or the three phases of finance: the accumulation, preservation, and then lastly, distribution? Um, I do want to open up to questions. I talked a lot, and there was a lot of information to cover, but I do want to give at least the next 10 to 15 minutes for questions. If not, we'll talk about the upcoming workshop series, um, and put a couple QR codes on the screen to make sure you're registered. So Tarna, I did not watch for questions because I was looking at the slides and making sure that my rambling didn't continue on.
Well, so far, no one has put one in the chat box. However, you are welcome to come off of mute and ask Aaron your question live if you've got something. If you don't have any questions today, I would be curious if you learned something. Could you put a yes in the chat box? I know I certainly did, and I know I still have a lot more to learn. But I would love to know if this was valuable for you. But again, please feel free to come off of mute and share any questions you guys have. Or if not, we'll get ready to share how you can get set up for our next time together. All right, Lisa and Lolita did. And you guys both have your cameras on today, so you get extra stars.
I appreciate it very much because those were the two people that I could see on the screen and I could interact with. And these are very hard to do virtually. So appreciate you both with the interaction because I could see Lisa and Lolita's head going up and down. So thank you for that.
And Caroline says, yes, very informative. And then Shelly said, okay, I'm coming to the party too. Thanks, Shelly. But any questions, or we're going to go ahead and move on? We'll get you guys out of here on time. We know we asked for an hour. We're going to stay diligent on that. All right. Okay, Aaron, you were so informative and so comprehensive. They've got it. They are ready. They're going to think about their questions and they're going to get on your calendar here soon. But go ahead and take us away, Aaron.
Got it. So as I said earlier, we do want to do these workshops over the course of the year. So as you can see on the screen, May 22nd is going to be our next date. We're going to talk about strategic generosity. Our goal at FEG is not to teach people how to be bigger givers. If charitable intent is something you're passionate about, we're passionate about making sure that you're being a better giver. And what do I mean by that is making sure that we're donating out of the right buckets of money. A lot of times people just like to write a check or give cash or donate to a charity just out of the sake of the ease, and that's great, but there's things that you can do that might make a bigger impact. One thing to give you just a little bit of a sneak peek is if you have, let's say, an appreciated asset. Here in Indiana, Eli Lilly, big company here. Their stock over the last couple of years has gone just to the moon. And so if you're a shareholder of Eli Lilly and you bought one share, let's just say at $100, and today it's valued at 800, you've got a $700 capital gain if you were to sell that. Well, let's say you don't want to sell that and you want to donate it to a charity. If the charity's set up as a 501c3 and they accept stock donations, you can transfer that one share of Eli Lilly stock to the charity. They sell it because they're a 501c3. They do not pay taxes and you get a donation. And so there's a lot of ways that we help different individuals and organizations give. And so we'll talk about being better givers. And this one likely won't last in a full hour, probably 30 to 40 minutes, and then we'll wrap up with questions. July, we're going to talk about legacy planning, August, investing, September, tax smart strategies, and then, as I said earlier, October and November, again, going into more of the tax planning season that we do in the fall. Tax deadline, if you're trying to make an impact on your tax return, most things have to be done before the clock strikes midnight on December 31st. And so we have to make sure those types of things are done prior to year end. If you want to register for this, no, when you register for strategic generosity, you can scan that QR code on the screen. We do welcome you to invite anybody. So if you did learn something today, please reach out to them and invite someone. As we said, we love to do these to give back. If you have questions, if there's something that I talked about today that you want to know more information on, you can reach out to us. Go to yourlifeafterwork.com. Send the question to talk to FEG@yourlifeafterwork.com. We do a lot of content that goes out on a weekly basis. So if you go to our website, yourlifeafterwork.com, we send out 2 weekly video series. One is market related and then one that is very planning centric. So if you want to have a next steps meeting, I encourage you, scan the QR code, go to yourlifeafterwork.com. We're here to help talk to you specifically and answer any questions that you have, especially if you're starting to plan for that next phase of, or that last phase of finance, which is distribution, and you have questions on wanting to be tax efficient or come up with a distribution strategy. Please reach out to us. We are more than happy to help and have that conversation. Thank you so much for joining us today. I look forward to walking you through our Better Giver series May 22nd. And it's just a pleasure to be able to be with you all today. So thank you so much for watching and listening. You have a blessed day and a happy Easter weekend. Tarna, anything else you want to wrap up with?
We'll wrap up with this one. David L. says, this helped my thought process as I headed to my distribution phase in the next couple of years. Well, first and foremost, congratulations, David. I know that that's an exciting time for you. And thank you all for being here. That is a wrap for today, Aaron. We'll see you guys all on May 22nd.
All right. Thank you all. Have a great day.